Most of us picture the stock market as a physical place, a giant room packed with guys in blue jackets, waving paper and shouting over each other to lock in a price. But today, that chaos has been replaced by silence. You open an app on your phone, you tap a screen, and you instantly own a piece of a public company. The famous trading floor in New York still exists, but it's mostly a set for television. When a company goes public and rings the opening bell, it's a marketing event. Over 90% of the actual trading volume has moved entirely off the floor. Between the app on your phone and the actual market, there is an invisible supply chain. In fact, over 40% of all U.S. stock trades never hit a public exchange at all. They execute in private networks called dark pools. Your buy button is effectively a storefront. In the milliseconds before your order officially executes, specialized middlemen firms have already analyzed it, matched it, and taken their cut. When you submit an order through a retail broker like Robinhood or Schwab, they don't send it to the New York Stock Exchange. Instead, they sell your order to a market maker. This diagram shows exactly how they make their money. It visualizes the spread, the microscopic gap between the highest price a buyer is willing to pay and the lowest price a seller will accept. Brokers sell the right to fill your order to these market makers in a perfectly legal practice called payment for order flow. The market maker fills your order and pockets that tiny spread. A fraction of a cent doesn't sound like much, but when you multiply that sliver by billions of trades a day, you get one of the most reliable profit engines in the financial system. To handle that kind of volume, the actual market lives inside windowless, heavily guarded server farms in places like Mahwah, New Jersey. Inside those buildings, high-frequency trading firms pay massive fees for a service called co-location. They are literally renting the rack space closest to the exchange's master servers. Being a few feet closer means their data travels slightly faster through the fiber optic cables, shaving off microseconds that translate into millions of dollars. The modern market is a physical arms race. It is driven by server proximity and processing power, entirely separate from the actual value of the companies being traded. This chart illustrates how institutions trade in the shadows. The bottom section shows millions of shares trading hands in a dark pool, a private venue run by big banks, while the public price line on top remains completely flat. If a hedge fund dumps 2 million shares on the open exchange, the sheer supply would crash the stock's price before they finished selling, so they do it in the dark. The rest of the market only finds out and reacts after the transaction is complete. This system of hidden leverage also extends to short selling. Brokers regularly lend out shares from customer accounts to short sellers. Because those shares get relent through a chain of brokers, more shares can be shorted than technically exist. This mechanical quirk, where short interest exceeds 100% of available shares, is exactly what fueled the GameStop squeeze in 2021. Meanwhile, companies themselves have a tool to engineer their own stock price. Thanks to a 1982 SEC regulation called Rule 10b-18, corporations can use their cash to buy up their own stock on the open market. This reduces the number of available shares, mathematically forcing the earnings per share metric to go up, even if the underlying business hasn't actually grown at all. Corporate executives also use perfectly legal loopholes to cash out. Under a 10b-5-1 trading plan, executives schedule their stock sales months in advance. Once that schedule is filed, they are legally protected to sell on those dates, even if they later acquire negative, non-public information about the company right before the trade executes. Retail investors often assume regulations are strictly there to enforce a level playing field, but many of these rules actually provide a legal safe harbor for institutional maneuvers that operate out of public view. The rise of passive investing shifted the weight of corporate ownership into a few central hubs. When you buy a standard index fund, your money mechanically flows into the portfolios of 3 massive asset managers, BlackRock, Vanguard, and State Street. Because their funds track the entire market, these 3 firms often sit at the top of the shareholder list for direct competitors, owning major stakes in Coke and Pepsi, or Delta and American Airlines simultaneously. When one asset manager profits from every player in an industry, they have less incentive to push a single company to undercut its rivals, as any market share gain for one would be an equivalent loss for another part of their own portfolio. This chart shows the system's emergency brakes in action. When trading algorithms feed on each other's momentum and a stock drops too fast, it triggers a market-wide circuit breaker. The exchanges instantly freeze trading for 15 minutes to force humans and machines to reassess the price, preventing the system from unraveling in seconds. And when a company finally does collapse, it doesn't just vanish. If a stock sits below $1 for too long and gets delisted, it drops into the over-the-counter pink sheets. These are zombie stocks. They still technically trade in a lightly regulated graveyard, completely disconnected from the primary market. The stock market functions as a layered machine of dark pools, market makers, and automated physical infrastructure. The price you see on a trading app represents the final output of a system designed for institutional efficiency, governed by specific rules and physical incentives that rarely reach the surface of the user interface.